Hi, ladies and gentlemen. My name is Marty Switzer. I'm the CEO of Contango Asset Management. I know many of you in the room today. Thank you very much for coming. A lot of supporters, which we're very grateful for, and some new faces as well, which we're very excited to be, showcasing WCM International Small Cap Strategy 2. This is WCM is a top quartile global equity manager from Laguna Beach, California. Contango has an exclusive retail distribution arrangement to distribute WCM to the retail market. This particular strategy we're talking about today, WCM International Small Cap Growth Strategy, has been a fantastic performer. It's last 12 months it did 37% after fees. Since inception for the last 6 years, it's averaged over 25%. And for those of you that are familiar with the WCM process, it very much adopts, the two key principles of moats and culture. Unfortunately today, the portfolio manager, Greg Ice, has had a personal situation arise, so he can't be with us, but we've got the next best thing is 2IC, Lakshman Venkitaraman. It's fantastic to hear. He's very deeply involved in the portfolio, so he'll be presenting. We're also going to have another client portfolio manager dial in, a guy called Hurta, who understands, the process of WCM around moats and culture, and can go into that in very sort of deep detail. That will be the first part of the session. We'll then serve lunch, and during lunch, we'll have a macroeconomic update from Peter Switzer, one of the country's leading business and financial commentators. No relation, I should say. And we're looking forward to that part of the presentation. So WCM will give you, very much the bottom-up sort of approach, and Peter will give you a macroeconomic update. And Pete, very nice to have you here today. But without any sort of further ado, we're going to throw to Lakshman. I'm going to ask him a few questions. He'll talk through the philosophy, the process, the portfolio. He'll get into some of the companies, talk about how WCM is investing right now, and then we can open the floor to questions as well. So thank you very much for coming. Lakshman, can you hear me okay?
I can. First, Greg sends his apologies. He had an emergency he had to attend to, but we are very delighted to have you listen to us, and we appreciate the opportunity. Thank you so much.
Thank you. Look, there are a number of people in the room that are familiar, Lakshman, with the WCM investment process, and we'll talk about that in a moment. But for those that don't know, can you just give us a bit of background about the business?
Absolutely. So the firm was founded in 1976, and really it went through a lot of trials and tribulations, different owners, but it settled upon its current philosophy and process somewhere around 2006-07, and the team has been very consistent since then. The process and philosophy has also been consistent. We are based in Laguna Beach, as Marty said, and we are a long-only asset management shop. We are a growth boutique. It's 100% employee-owned, and all of us are generalists, and there's a reason behind it, and I can talk to it as well at some point. We have 5 or 6 strategies, and between those strategies, we manage somewhere between 80 to 85 billion. There are sister teams for WCM, but the team here in Laguna is managing all the global growth strategies, and it's one consistent team and process and philosophy. I'll pause there so that we have enough time to talk about the process, etc. So, Marty, if you want to drill into anything specific about the firm, I'm happy to do so.
Yeah, there are 67 employees, 28 of which are owners in the business. But look, what's really made WCM, well embraced is, the uniqueness of the investment process. Lakshman, maybe you could talk us through, the 2 key attributes and how that relates to the portfolios that you manage at WCM.
Absolutely. And the 2 key pillars that differentiate us from the crowd is moat trajectory and culture. On moat trajectory, we believe most of our peers focus on the size of the moat. Everyone wants to buy companies that have a very strong competitive advantage. What differentiates us is that we are focused on the direction of the moat. It is more important for us that the company that we invest in is expanding its competitive advantage. And the companies that we invest in generally do so by either developing new sources of competitive advantage, or they are getting better in their existing sources of competitive advantage. And as a result, they are generally taking share from competition, or doing something differentiated, which enables them to grow faster than the rest of the market. The second piece I would say differentiates us from the crowd is the culture. And I would say my personal experience, I joined WCM because we believe we have a very phenomenal culture. We love to work here. We love to come into the office on a daily basis. And we believe it's an important reason for our success. And we completely believe that firms that have a great culture that is aligned with the competitive advantage generate outsized returns over the long run. And the final piece, if you would, there are not many companies that fit these two attributes, and therefore we tend to run very concentrated portfolios. The small cap strategy holds anywhere between 50 to 70 names on an average.
Lakshman, maybe you could just drill down a little bit in terms of some of the, I guess, what you actually do with regards to how you actually analyze culture. So you have a full-time culture analyst, you've got the collaboration with the Harvard professor, James Heskett. Maybe just talk through some of, I guess, the techniques you use to determine what a culture is like within a company, and then how you apply that to the investment process.
Yes, and thank you. And the one thing to understand is why we have culture as one of the things that we focus on, right? And if you go back to the history of the firm, and I've been in the firm a little over a year, so I'm sure people who have been here longer can talk better about this. But the culture was not always great, and it was always a revolving door. And the founders, the owners today actually bought the firm from the previous owner and actually completely changed the culture, did a 360, and you can see the results today. And therefore we believe that we want to kind of actually invest in companies with great culture. But having said that, it is very difficult to define what a great culture is. And if we said that we have perfected the art of analyzing culture, that would be kind of an incorrect statement. We are still learning, but what we try to do is we are trying to assess how the company will behave when no one's looking, or how people behave in a company when no one's looking, how people behave when times are bad, because we believe that's the ultimate margin of safety. That is what, that is one of the sources of good downside capture that we have in our portfolios. And there is no one way to do this. There is a bunch of different questions. And one of the reasons we like that aspect is because it is very difficult to replicate. And we find that most of our peers do not believe in using culture as a tool. We spend a lot of time, to your point, we have had a Harvard professor come and talk to us in depth about this. And we also, beyond that, invested in a full-time analyst who completely devotes all his time and energy towards culture. And it goes from a set of exhaustive questions that we ask our companies that we invest in. We also do a lot of checks with former employees of the firm on what their experience was with the firm, how the firm treated them when things were bad. And essentially it's a mosaic, and we put all these pieces together and come up with some sort of picture of what the culture is like. And it is not quantifiable, and which is why we just cannot kind of tell you, if we can assign a particular number to a culture. It is hard to say what good culture is, but when we see it, we understand what a good culture is. And we certainly understand what bad cultures are, and we make every effort that we can to kind of avoid companies that have bad cultures.
And I think you understand that because I guess you've invested so much in your own culture. It's one of the things you talk about. The firm very much walks the walk as a full-time culture officer internally. So there's learnings from your own business journey that you've been able to apply to the companies in the portfolio. We're lucky enough to hear Kurt talk yesterday. And one of the things that he mentioned, Lakshman, was, I guess, it's more of an art than a science. It's very much a proprietary process that you use. But he talked about the term scuttlebutt research from, I think, Phil Fisher. That's something that is, I guess, a big part of how you actually determine what a culture is like. Effectively, investigative journalism, police work, acting, finding out information and putting together a mosaic.
That's correct. I mean, and to your point, it's an art. And like I said, if I said that we have perfected the art of analyzing culture, that would be a mistake. We are constantly evolving the process. one of the things that one of the efforts underway here is to how to improve upon that assessment. And recently we've also hired consultants who actually also do a deep dive into the corporate governance aspect at much greater depth than what we have done in the past. We constantly talk to professors and experts on culture to come and talk to us and help us improve this. And there is no one right way to do this. There are several different ways to do this. And one of the things that we are proud of is that all of our colleagues have very different backgrounds, and as a result, they have very different takes on culture. I mean, the culture in India is very different from the culture in China, for example. And what the different backgrounds help us is to actually assess the culture with the right context, because to have a similar expectation from a company in India when you compare it to a company in the US would be incorrect. And therefore, having a local context is also important when we assess cultures of companies. So it's an evolving process. We are constantly striving to get better at it. And I think it is a process that will never end.
The firm, as we've said before, a full-time culture analyst in the process of appointing another one. We can make that analyst available at any point in time if anyone in the room wants to understand more about the actual process. But look, it's a good segue to the next question. You mentioned it before, Lakshman, the downside capture. How has the strategy managed to perform, so well on the downside? Talk us through that whilst still capturing so much of the upside, and we can see that through the numbers.
Absolutely, Marty. Thank you for that question. So first, we do all the things that you would expect a good growth manager to do. We avoid excessive leverage. We are very sensitive to poor corporate governance, and there are a bunch of other things that we do that is typical and that is the norm. But beyond that, the two things that underpin our process also is responsible for our downside capture. The two things that differentiate our process are moat trajectory and culture. Moat trajectory, we find that companies that are expanding its competitive advantage actually perform better in downturns. Usually these companies are gaining share when things are bad. Usually the competitors are actually falling apart, and that gives an opportunity for companies which have a positive moat trajectory to get even better. Adversity is actually a good thing for these kind of companies. The second thing, I think this might sound a little bit corny, but I think culture is the ultimate downside capture, really. I think, like I said, culture, we define by culture by sort of trying to assess how employees behave in a particular company when things are bad. And usually it is the bad times that determine how the company does in the long run, right? And I would say we do things that are typical of most growth managers. And on top of that, the moat trajectory and culture focus also adds to the downside capture. And to your question on, how do we actually perform well in up markets? It again goes back to what we focus on. It's the moat trajectory and culture. We find that, I think, our belief is that companies outperform in the long run for a very simple reason. The reason is that they beat expectations over the long run. And we find that companies with a positive moat trajectory and good culture, we use the term defy the fate. And it's another way of saying they defy the expectations. And as a result, these companies continue to surprise positively for a very long time. Most investors tend to sort of revert most companies to the mean pretty quickly if we are doing our job correctly. And if we are finding companies with positive moat trajectory and good culture, we find that these companies tend to defy the fade and therefore beat expectations for a lot longer duration. And therefore that sort of portfolio leads to outperformance even in up markets as well.
And just sort of close out that point on, I guess, the downside capture strategy. What is particularly, important to note, the downside capture is 67% in the small cap strategy. You've achieved that result by being sort of fully invested. You're not going to cash, cash more than sort of 5%, which guess is an important point, isn't it, Lakshman?
I would be remiss not to point out, 2020 was case in point, right? I mean, it was one of the strategy's best years, and we found it was a true live experiment for our strategy, where our portfolios did, especially small cap growth, did very well during the really disastrous year for many of our peers.
Can you talk us through some of the key features of the strategy? Number of stocks, sectors, some geography.
Yeah. We, like I said initially, we tend to hold somewhere between 50 to 70 stocks, and generally, when we can find a lot more ideas, it tends to be on the higher side. And currently, we are finding a lot of really good ideas, and as a result, we hold somewhere around 70 stocks. We are not intentionally trying to avoid any particular sector. However, organically, because we focus so much on moat trajectory and culture, organically our portfolio is typically overweight to technology, consumer discretionary, industrials, and a few other sectors that you would expect a typical growth manager. But I would say that is just a manifestation of the current environment. If we were able to find good moat trajectory and culture in energy sector, we would happily own that as well. So the sector, dispersion versus the index is more a result of our focus versus an intentional versus an intentional portfolio construction methodology. And countries, we do not, we are trying to be country agnostic, but generally, again, our bottom-up portfolio construction leads us to country overweights and underweights.
I used to say before, a bottom-up manager, and a lot of your peers and colleagues, don't like to make predictions on the macro environment. But can you sort of give us your view on just the current landscape, but probably more importantly, what are the countries or sectors at the moment that you think are interesting for Australian investors to consider?
Like you said, we are not not top down, and I will caveat my comments because I haven't been great at predicting things from a top down perspective. We are much better bottom up stock pickers versus not. Having said that, we find a lot of attractive opportunities in countries like Japan and even in India. And many of the Nordic countries are also always a source of great ideas for our portfolio, really. And the China, we have one of our strengths is also the generalist strategy, one team across different strategies and across geographies. As a result, we have good stocks in China as well. So, and I would say from a sector perspective, I think technology remains like an evergreen sector. We live in an era where digitization is a trend that is still at its infancy. We continue to believe that it has a lot of legs, and we will continue to find a lot of good stocks in the technology sector, especially in areas like semiconductors, because I think semiconductors is almost every one of us is holding something that has a semiconductor content in it, and we see that expanding constantly, and as a result, we have enough investments in the portfolio that are leveraging that trend as well.
Can you talk us through some stocks in the portfolio that you like at the moment?
Sorry, Marty, you cut out at the end. You just a couple of stocks, right?
A couple of the stocks that you like in the portfolio at the moment.
Yes, I will talk about Synergy first. It's an analog power management integrated circuit manufacturer that is based out of Shanghai in China. What does the power management integrated circuit do? It's between the source of power, which is your outlet, and an electronic device, and it smooths out the volatility in the power source so that these sensitive electronic components are protected. And that's the basic function of a power management integrated circuit. What is unique about Synergy is their hybrid manufacturing model. They call it a virtual IDM. IDM stands for integrated device manufacturer. As many of you might know, a modern fab is very expensive. A digital fab that someone like a Taiwan Semiconductor constructs costs upward of 15 billion. Synergy makes analog chips, and even those fabs costs a few $1 billion. So instead of deploying a lot of capital on an expensive fab, what Synergy does is they have a hybrid manufacturing model where they have a very close partnership with a outsourced foundry partner, where the foundry partner manufactures their chip, but Synergy has a very strong control over the process of manufacturing. And as a result, the sources of their competitive advantage are one, they have a cost advantage because one, they are based in China. The engineers are relatively less expensive compared to the rest of the world. Plus the hybrid manufacturing model, which is asset light, gives them an advantage where they do not have to invest the capital, but get the benefits of integrated fab. Second, it's also the deep relationships that they have cultivated over the years. This company was founded in 2003, if I'm not wrong, and they over 18 years they have developed a lot of deep relationship with their customers. Third, the source of the competitive advantage, the switching cost in this business is very high. Like I said, the chips protect very sensitive electronic components, which can be orders several hundreds of dollars, and the chip that Synergy supply costs a few cents really. And so the incentive to switch is very low. And as you can imagine, over time, all these sources of competitive advantage are getting better, which is why we believe the company has a very positive moat trajectory. That is, it's expanding its moat constantly. And second, the culture. I've been an engineer in my prior life. I worked at Microsoft for about 6 years as an engineer, and I've been to their Shanghai office, and it is no different than my office in Redmond when I was at Microsoft. And I can see, and the founder is actually China American Chinese who graduated from a US university, worked for a US firm for a long time, and then went and set up his own firm in Shanghai. So as a result, the culture is very much Western. And this is important because it is very important to attract the right kind of talent, because analog engineers are very difficult to find. And as a result of the positive mode trajectory and the strong culture, we feel this deserves a spot in the portfolio. The company has done really well. I mean, it has grown its revenue at more than a 20 to 25% CAGR, and it's still just about 500 million in revenues. We believe that companies like this can easily exceed $1 billion or $2 billion in revenues over the next 5 to 7 years. That's number one. If there is a question on this, I'm happy to answer. If not, I'll talk about another example as well, really quick. Soitec is another company in the portfolio. They manufacture specialized engineered substrates on which we manufacture semiconductor devices. Every one of you is holding a device that has some component that is made by Soitec, because they have 100% share in radio frequency chips that are used in smartphones. And the reason they have this monopoly-like position is because of a technology called Smart Cut that they invented 25 years ago. Smart Cut, basically what Smart Cut does is you are able to take extremely thin slices of one material and deposit it, basically cut it very smartly, and you put it on top of another material, and as a result you get a composite material which has characteristics that are much more superior than the traditional silicon that has been used in semiconductor manufacturing. As many of you might have heard, Moore's law is more and more difficult to maintain or keep up. And as a result, things like engineered substrates will be very important in keeping Moore's law going. And Soitec has 25 years, in developing this technology, and they have the sources of their competitive advantage. One, 25 years of know-how, which gives them a cost advantage. Second, they actually have a 80% share of the market. The other 20% belongs to a company that licenses technology from Soitec, and therefore effectively they have a 100% share though. So it's a monopoly-like share. And the market is actually going in their favor because, like I said, Moore's law is, we are struggling to maintain Moore's law, and we would need the use of engineered substrates to keep Moore's law alive. And as a result, we feel the, the trajectory of its moat is certainly very positive. The cultural aspect was a complete turnaround. This was a really badly managed French company a while ago. 5 or 6 years ago, the founder ran it like a science experiment and almost ran it to the ground. A few external investors invested in it and brought in a new CEO, and he's done a remarkable job with the culture. The company is more amenable to working with partners and making great and prudent capital allocation decisions. And as a result, we have seen the results. They have grown revenues really nicely. 500, 600 million in revenues. They say in the next 2 years, it can get to 900 million in revenues. And I think that's the first step. I think this company can grow for quite a long time. I'll pause there. Go ahead, please.
One of your colleagues in Brian Hurta, who many in the room know, Brian's a client portfolio manager at WCM. Just for the questions process, Brian can also talk a bit more about the investment process. I think he's going to come in now. Yeah. Here he is, Brian. I'm mute. You're on mute.
Hi, everyone.
G'day, Brian.
Okay.
Thanks
Good
for joining.
day.
Thank you for obviously filling in at such short notice. And Lakshman has done a fantastic job today talking about the international small cap growth strategy. We're in the point where we might start going to questions from the room soon, but after that, we might get you just to sort of maybe just to recapitulate, I guess, some of the the key components of the investment process at WCM, and why it's been able to be rolled out through, I guess, the suite of strategies that you've got available from the large cap to the small cap, also to the long, short, emerging markets. But Lakshman, are you finished there on that point with regards to the last company?
Yes, absolutely. I mean, yeah. If you have any other questions about the companies, I'm happy to answer them. If not, yeah, let's go into some Q&A, please.
I'll go to the floor now for any questions with regards to presentation today. Yeah, Luke.
Thanks for the update, guys. Tell us more about the culture at WCM, and perhaps there might be some learnings for us within our probably small organisations that we work with, small firms, which might make you a company of choice for employment. Some great cultural beliefs that you have, why people enjoy working there, that we might be able to tap into.
Really a great question for Brian.
Yeah, I'm happy to take this on. Sure. Yeah, I think, thanks for the question. First, I think, the culture is really what distinguishes us. We kind of view it as our best competitive advantage. You're absolutely right. I think it does enable us to attract and retain the most talented investment professionals out there. We're quite unique. You may have heard this or have seen this, but our two core values are fun and gratitude. I think that says a lot about who we are. The fun part is, we know that if you're having fun, you're going to work the hardest. You're going to, bring the best that you possibly can each and every day. And having an attitude of gratitude, I think, just enables you to let go of that ego, to think about others before yourself, not get trapped into overconfidence or arrogance, things that can really hurt performance and destroy an organization. So those two things are very important. Those are our two core values. That's quite different than what you might hear from another manager that might talk about, hey, what's important to us is everybody be really smart and work hard. Those are, to us, just table stakes. That's like the price of admission. What's most important is things like, having an attitude of gratitude. It's the freedom to do things differently. explore new ideas and approaches different than maybe you have done them at prior firms. So that is what I think is really unique about us and gives us a real distinct advantage versus our peers.
Maybe I can add something real quick from my personal experience, and comparing and contrasting our culture versus other cultures I've experienced. Right, one of the things we are very sensitive to is to not have any finger pointing here. Right, I mean, for example, I mean, we do not have any attribution when it comes to compensation, and there's a reason for that. I mean, we believe that. And when I introduced the firm, I talked about how we came to our process and philosophy after a lot of trial and error, right? I mean, we were not what we are today, and we learned through a lot of really bad mistakes what we have done incorrectly, and we arrived at this process and philosophy after making a lot of errors. And the only way we have achieved that is by having a culture where it is okay to admit mistakes. And I'll tell you one of the things that is different, and one thing that you should have in mind is that we are a very lean team. Generally, for the number of strategies we manage, we are relatively a smaller team. And one of the reasons we are able to do this efficiently is because it is okay here to say, I don't know. It is okay for us to, as analysts, generally on a daily basis, to do just incremental work. There is never sort of, unwarranted criticism. When you don't know, you don't know. So we find that process very efficient, as a result of which we are able to go through a lot of companies much more efficiently than what I've found at other firms. And it is very refreshing to be, to Brian's point, to be able to speak your mind, to do things differently, and be okay to admit your mistakes. And as a result, we kind of go through a lot more companies than what I've seen at my previous companies, if you will.
Great point.
Yeah, John.
Where's Sweden to these? But on a serious note, you've got some significant exposures to foreign countries, yet you're fully unhedged. The Australian is also unhedged.
Yeah.
Second layer of unhedged. Can you walk us through why you choose to be unhedged with such an exposure to quite a broad range of foreign currencies?
Sure. If I could paraphrase the question, I think I heard it was why do you not hedge, and do you expose yourself to volatile currencies? Is that the essence of the question?
Yes.
Okay, great. Yeah. Well, we think it is very difficult to make a currency forecast first and foremost. And we don't think it's a good allocation of our time or resource to try to do so. We've also have just over the years, we have discovered that that currency impact tends to wash itself out. It tends to even out over the long term, especially over our investment horizon. So short answer is that it just really hasn't been proven to be a really good return on our time to focus on currencies. I would say just about our currency exposures, most of our companies are in countries or domiciled in current or have currencies that are quite stable, that don't fluctuate as much as you might think. And they're actually quite, the companies themselves oftentimes are quite diverse. And so they are hedged themselves. So we feel like, with the hedging that the companies are doing themselves, with the fact that over the long term, currency has been essentially a wash, that it would not be a good return on our time to make active decisions around currencies, and trying to determine where we should be hedged, how much we should be hedged. We think sticking to bottoms up fundamental stock picking makes the most sense.
Large cap strategy does have a hedged version as well, though, which we manage externally.
Both layers.
Just large cap, yeah.
But you manage both, so you manage the layer between here in the US and then the exposure of the fund currency, like domicile or fund.
Excellent question. I'll come back to you offline on that. But we've got a third party doing it for us, so but we'll get back to that question. Yeah.
Just
Dan, yeah.
two questions. One is, how big is the small cap fund? What's the capacity? And two is, you've got statistics about market caps and return on equity and so on, but you don't have anything about earnings per share growth. So I'm just curious about the underlying characteristics of the portfolio in that sense.
Okay.
So I can just take, so in Australia, we've got about 250 carved out of a strategy at the moment with the same capacity globally. US is about 1.5, and probably go up to 1.7. It's currently about 1.3. The performance has been outstanding, so there's a lot of demand for the strategy. But Brian, is there anything else you want to add to that point? I just thought that was an important point for the Australian investors.
Yep, you're absolutely right. Yeah, we're at about that level, 1.3 billion in current AUM, and we see capacity, up to but not exceeding 2 billion. So roughly 1.7 is probably the upper limit on capacity.
What about the earnings per share growth of the portfolio? What does that look like in aggregate?
So the question was earnings per share growth of the portfolio in aggregate. Is that a Lakshman or a Brian? We both want to comment.
Sorry, Marty, I couldn't catch that question. Do you mind repeating that once?
The earnings per share growth in the portfolio on aggregate?
Honestly, I don't know. I mean, I think, I don't know, Brian, do we?
Let me take that one. I think, it's not something that we would focus on. Here's how we think about growth, and earnings growth or free cash flow growth is really just what it could generate over the next 5 years. And what's also important too is just the diversity of growth profiles from the companies in the portfolio. Some of our companies could grow, closer to 10% bottom line if we're looking at earnings per share or free cash flow, and some of them could grow much faster than that, maybe 30% or more, or even higher. So, that's part of the beauty of the portfolio is there actually is quite a diverse set of growth profiles. And we really look at it on a company by company basis. But most importantly, we're looking at 5 years. We're looking at what can the company achieve in free cash flow or earnings per share over the next 5 years. And that's how we're going to value the company. That is what is most important to us, not what the company is going to earn over the next year or two. Because for many of our companies, they continue to invest. And so in the very short term, their earnings might be depressed, but they might have latent earnings power over the next 5 or more years that we think that the street isn't currently discounting. And that's a real key part of our investment process, is just understanding the power, the durability, and the quality of that growth over the next 5 to 10 years.
And I would also add that we are not targeting any particular amount of growth as such. I mean, we do not believe that leads to outperformance. As I said earlier, we believe that companies with positive moat trajectory and culture defy the fate, and that's what leads to outperformance. And we are perfectly happy buying those companies that grow 10 or 11%, but for 10 or 15 years, and grow their earnings a little bit faster their revenues. I mean, if we can find a lot of such companies, we would happily fill the portfolio with that kind of companies as well.
That's a great point. I think there is many growth managers have an arbitrary threshold for growth. And you could be seduced into doing such that, selecting companies that might be, juicing their near-term results at the expense of the long-term health of the business. They might be pulling levers, pulling business forward, and it may not come, or it may come at the expense of some of the long-term potential for growth. And so that's something that we pay much more closer attention to, is just how's the company going to be positioned in 5 years. It's not the whole philosophy around moat trajectory is not what position they're in now, but what position they're going to be in 5 years.
Any other questions? Matt, you've been a big supporter of the large cap strategy, quite a lot. Anything else?
I'd be interested in, you mentioned the Chinese company before. How do you invest in Chinese companies? How do you view the corporate governance, and just maybe some of the other exchanges that you invest in? Sort of similar sort of question. And do they fall under your emerging markets piece as well? So I'd just like to understand probably
outside of your developed stuff, that'd be interesting around emerging markets and in particular China.
Lakshman, do you want to take the China related question?
I heard the question correctly. If Marty, do you mind just summarizing the question for us, please?
Yeah, how you go about investing in markets like China, and then I guess probably more broadly emerging markets?
Yeah, I mean, the approach is no different, but like I said, we are pragmatic. I mean, I made the point earlier that one of the advantages we have is a team that has very diverse backgrounds. And so we have two people who are from China. I grew up in India, and we have other people from different geographies as well. So we bring in a lot of local context when we try to understand the culture of these companies. Like I said earlier, trying to kind of understand the culture of a Chinese company from a US lens is incorrect. And therefore we have to sort of adapt that analysis to the local context. And we do that, and we have a lot of experience, and our diverse backgrounds helps us in that regard. And we are pragmatic that, what is a great culture in the US might be different in different countries, right? I mean, for example, many Japanese companies almost always, the employees the employees are treated very differently. I mean, you will find that most Japanese employees will be in their firms for 25, 30 years, which is the norm. And typically the companies do not let employees go, right? Is that bad culture or is that good culture? I don't know. I mean, it's just different culture, and we have to kind of take that in the context of the country that we are investing in, if you will.
And what about sort of technically with investing on the Chinese exchange? Like, how do you actually go about that in terms of your shareholder rights? Or how do you actually do investing on them into a Chinese company? And how do you view their corporate governance?
We have a person who specifically looks at China A shares, actually. So she spends almost all of her time actually looking at Chinese companies, and she's assisted by our culture analyst. And like I said, we have recently also actually engaged a few people, or engaged someone to kind of look a little bit more deeply into corporate governance and help us on that aspect as well.
Yeah. One thing I might add too is that related to China, it's a good example of us just maintaining a high bar. As it pertains to China, I'd just say the bar is set pretty high for us to do real work on a company. We really try to sift through the space and make sure that we're focusing our efforts on the highest quality companies with good governance, good disclosure, businesses that we could understand. That is a driving force within our analysis as it pertains to China.
Okay, I've got one last question, John.
You made a number of new investments last year in the middle of a global shutdown. Can you walk us through a bit of your approach to culture analysis from Laguna Beach? How you can assess culture, sitting in Laguna Beach, try and make investments in Sweden, Japan, places like that. I understand existing companies, that makes a lot of sense, you're familiar with those, but a brand new company, how do you do it from
Yeah.
Again, I couldn't catch most of the question. It's not very audible.
I think I'll paraphrase it. I think it's how do you do your job in Laguna Beach when you have companies all over the world? Is that essentially the question?
Yeah, particularly how do you invest through the pandemic? We bought a number of new. How do you assess the culture of those businesses when you're sitting in Laguna?
Actually, it's funny. Actually, the COVID has been kind of. I mean, I hate to kind of minimize the disease. I mean, it's been terrible for many people in the world, but it's been actually a blessing from a analysis point of view. Almost all management teams are constantly available. Things like Zoom make it pretty much in person. We are having, I would say, in terms of productivity, as high a productivity as we have ever seen. And in fact, I think many of us are actually also looking forward to getting back to travel so that the pace is kind of a little bit reduced in some sense, because I think the good or bad thing about being locked up in your homes is there is nothing much to do but actually talk to companies all the time, and that's what we do on a daily basis. I mean, just this morning I had 2 calls with experts who are formers of a company that I'm interested in, and we do that day in, day out, and almost all of our analysts are constantly engaged. In fact, during the COVID, one of the things that when the disease broke out and was, I would say, in the second quarter or so, we made it a point to reach out to all our companies and essentially kind of have this discussion with them as to how they are handling this from a cultural aspect. And I mean, and many companies had the right set of tools to deal with the disease to help their employees, etc. And we were very impressed by how our companies have managed through this disease. And I mean, in cases where we found cultures were broken, and we didn't find many really, we actually kind of were okay kind of exiting that company as well.
Yeah, I'll add to that too. Lakshman's right on the money. I mean, we've been more productive than we've ever been. Just having everyone together, we've gone through more ideas than we've ever had in 2020 than in any prior year. So that's been a good thing. And our access to management and other experts has been really, really good. However, saying that, we're really dying to get out on the road. I think there's going to be a lot of us out on the road, seeing companies, attending industry events, talking to industry experts, doing that boots on the ground type fundamental work that has been so key. But what we have is, as Lakshman described, is just we've become more resourceful. I've seen it with the number of contacts that we've developed in 2020. I think the scope of contacts, the breadth and depth of our contacts have only expanded. And I think we've gotten a lot better with the type of questions that we're asking the people that we lean on to develop our culture work. So we absolutely would admit that we're missing that face-to-face walking around company headquarters and sites and meeting middle managers, but our access has been pretty darn good, and we've been able to do the job, I think, quite well despite the pandemic in 2020.
Yeah, I agree. I mean, there is no substitute to actually kicking the tires, and I mean, I think I can speak for all analysts here that we are all ready to go back on the road and actually meet the companies in person.
Guys, we're out of time. Thank you very much for helping out at such short notice. Very grateful for both of your time and effort, and we look forward to having you in Australia in the very near future. I know you've all had the vaccine, so you'll be here sort of around September, October. Guys, Greg does apologise as well. He'd be more than happy to do a phone hookup with your respective businesses at any time. So thank you very much for attending this presentation.